So today we're going to discuss MACD, also known as the moving average crossover and divergence indicator in Forex. The agenda is to quickly tell you a little bit about who we are and what we do, and then we will discuss the theory behind the MACD indicator. Some of you that have been in FX for a while will immediately know what it is and how it's used. For those of you that are new, it's a slightly more technical indicator, so we will go ahead and describe it in detail. Then we'll also obviously address the uncertainties around the MACD, which is, does it work? How well does it work? Because there's always a bit of debate between traders how useful this indicator actually is. We will then discuss how you actually use it, because it can be used quite accurately if you use it correctly. And then, of course, we'll discuss setting of stop losses and managing risk when using MACDs. Last but not least, we'll of course talk a little bit about the dangers in FX and end with a Q&A. And if I have not answered any of your questions or if I've missed something, just feel free to email webinars@hotforex.com and your account manager will be very happy to get in touch with you. Before we proceed, I am required to read you this disclaimer, so please bear with me. The contents of this material are provided by a third party and not Hot Forex and are for informational purposes only and do not constitute investment advice. Hot Forex and Blue Sky Binary assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Hot Forex unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if you have any doubts. Give you a quick intro on who we are. We are Blue Sky Forex. We are an education, research, and trading group. We are basically a bunch of senior traders that teach FX strategies and provide 24-hour support analysis to both binary option and FX traders. We are doing this webinar on behalf of Hot Forex in order to educate you with the hope of making you profitable FX traders in the long run. So the market generally will present itself either as a breaking out and trending market like we're seeing today in the European morning day. You've seen some pretty big moves on the British pound and also on the euro-related pairs. And generally speaking, trading in the direction of these moves, or also known as trend trading, is more powerful. It's more profitable in the long run, but it does take some getting used to. It takes a keen eye, a more technical eye in identifying these trends and knowing what is driving them. Generally speaking, these trends are driven by news. And when you have identified this, you can successfully trade them. However, more often than not, the market actually presents itself in a mean reversion mode, which means that it's kind of ranging. It's moving from support to resistance level and bouncing back. And this is slightly more common. It's easier to identify. And when the prices turn, right, after hitting support and resistance levels, offer some pretty good mean reversion trading opportunities. The MACD can actually be used for both trend trading and mean reversion trades. We will focus more, although we won't completely ignore, but we'll focus more for the purposes of this webinar on mean reversion markets. All right. These are markets that are not explosive, fueled by news, major trends, because then it's pretty obvious which direction to trade in. This is more focused on the markets when you have a price moving in a particular direction and then knowing when you should take a trade in the opposite direction if you believe it's overbought or oversold or other conditions. So let's start with what exactly MACD is. Definitionally speaking, and you can see to the left of this chart at the bottom, there is a MACD indicator that's been posted. Now, this is a 4-hour chart. We recommend using MACDs on longer time frames. I'll discuss this a bit more in detail when we'll discuss calibration for your charts. But generally speaking, the MACDs, we would suggest using not on 1-minute charts or tick charts or 5-minute charts. You do need more data, more periods, and also you need larger time frame charts because these are basically predictive to some degree of larger time frame trend reversals, right? We're basically looking to catch reversals here. So the MACD, also known as the moving average crossover and divergence indicator, is a visual representation. So what you see here are three things, right? You see a purple bar charts, you see a green line, and you see a black line. Now, sometimes the colors might be a little bit different, and sometimes the color of the histogram or these bar charts may be a bit different depending on which indicator you're using, or if you're using MT4 or some sort of different charting platform. But the mathematics behind it is the same. And I'll explain exactly what these three mean. But basically, the MACD is a visual representation of the difference, okay? It's the difference, the mathematical difference between the currency's, the underlying price of the currency's 26 period exponential moving average and the 12 period exponential moving average. Okay, the 26 period, because it looks at 26 periods, historical periods. So in this case, let's say it's an hourly chart. It'll be looking at 26 hours of data. Okay, and this is known as the slower moving average. Okay, then the faster moving average is effectively the 12 period moving average. All right, it only looks at the last 12 periods, or in this case, the last 12 hours. Okay, now for those of you that are wondering what is EMA, the exponential moving average, it's just a fancy term for an average where the data points are weighted more towards the current past. So we're talking the last few hours. Whereas if you compare it to a classic moving average, which is just the MA, that equally weights the data points. All right. So all the exponential moving averages, if you compare it to a standard moving average, is that it weights the recent data points higher. That's it. Okay. So just to recap, the MACD is basically the green line here. Okay. That's the actual indicator line, so to put it. And that is just the mathematical difference between a 26 period moving average and a 12 period moving average. Okay. It can be used on most time frames, but again, as we said, it should be used on larger time frames, all right, in terms of the charts. Now, you'll also notice that there's a 9-period EMA, a 9-period moving average, all right, that's the fastest moving average. And this, by the way, this is represented by the black line here, okay? This is actually known as the MACD signal, okay? And what this basically done is it signals potential, I'm not saying definitive, but I'm saying potential entries on where you can open or think to open a long or a short entry. Okay, so when the MACD moves below its own 9-period EMA, this is a bullish signal. All right, and the vice versa or the reverse holds true when the MACD moves above its own 9-period MA. All right, so what does that mean here? So here you can see the black line, okay? This is the 9-period MA. And when the MACD, this is the green line, when this is actually crossed from below, right, this is a bullish signal. And the vice versa holds true when it actually crosses from above and it actually pierces the 9-period MA from above, that's a bearish signal, all right? And this crossover between the moving averages is basically known as it's actually in the name, the MACD, right? So the moving average crossover and divergence indicator. So here, basically, you are looking to open potential long positions when you get this happening in the markets. And one thing to note is that you'll see this sometimes, or to some degree, confusing histogram, right? These bar charts here. What does that exactly mean? So in this case, it's seen in purple. This is actually just the difference between the green line and the black line, if that makes sense. All right. This purple, these bars here are simply the difference, the mathematical difference between this green line, which is the MACD, this black line, which is the 9-period moving average, okay? And what it measures in commercial terms is basically the explosiveness or the interest behind the move. And that's the, I shouldn't say beauty, but that's the thing that separates the MACD from more simple indicators like relative strength index or basic stochastic indicators, is that the histogram here that you're seeing, these larger bar charts or these increasingly smaller bar charts, if you go back in time, this basically represents the explosive or the liquidity or the volume behind the move. Now remember, we have no, as retail traders, we don't really have too much insight on the order book in the market. That would be great if we could see all the big sell and buy orders, right? But we don't have access to this data generally. But what we do have is composite or surrogate indicators, which can give you some clue on how powerful the move is. So look at this large green, or in this case, blue candle, right? This is a large bull move up. This was most likely triggered by news because I'm looking at the 4-hour chart. And notice also how it coincides with a higher histogram, right? Notice how the purple lines are actually larger in size. This means it's an explosive move. So generally speaking, this histogram is showing the interest behind the move in the market. All right? So this is MACD. Now the question is, does it actually work? Can you simply go ahead and when the green line crosses the black line, or when the MACD crosses the very small, the short period MA, the 9-period MA, when it crosses it from below, can you open a long position? When it crosses it from above, can you open a short position? The answer is yes and no. All right, right. With any indicator, none of these are holy grail. The MACD is probably the most popular indicator out there used by FX traders, followed by the RSI. I mean, it depends from region to region basis. But let's explore why it can be used. All right. So firstly, in an overall ranging markets that are not driven by heavy news flow, right, or systemic trends being sort of structural trends that are, let's say, causing perpetual weakness in a currency like FOMC, going into an FOMC announcement, or let's say there's some quantitative easing that's being issued by the European Central Bank that's causing a drag on the euro. When you don't have these type of weird events happening or these one-off events, generally speaking, the MACD can be very successful in signaling a turn or a change in price, and it can also indicate potential entries, either long or short. So when you have normalized market conditions, the MACD can work very well. What you're seeing today, what you're seeing in the last few weeks, for those of you that are losing money or that are having a tough time, it's affecting the broader market. You are seeing a lot of asymmetric moves, very large buyers, a lot of pre-positioning ahead of big events, a lot of systemic trends, and this is causing a lot of volatility. So if you're not having so much success with the MACD, is it because it only functions really well in more normal type of conditions? Now, the interesting thing is that if you are simply going to be trading crossover, right? So the MACD can be used in two ways. One is the simple way, which is basically looking at the MACD line and seeing when it crosses the shorter period moving average from below, indicating a long entry, and you would open a long there. And notice how it coincided with a sharp rise in price. Or a short entry when the MACD crosses the black line or the 9-period MA from above. You can use that. It's a bit more risky. A slightly more technical and I would say intelligent way is to use it using divergence. All right, so look for MACD divergence. All right, so what divergence is basically you are looking for the following. The price will continue to create a high. Let's say we're looking at a larger trend, an uptrend. Please notice my chart here. The price creates a swing high somewhere around the point 11950. All right, this is the US dollar, Japanese yen. This is a daily chart. And of course, the MACD also, because it's an explosive move, creates a high as well, right? You see the hill here as evidenced by this histogram. All right. Now, this is not a place to open a short trade, right? Yes, it may look overbought, but you don't know if this is just a temporary swing high and it's going to go on and post another swing high, and thereby making your stop losses blown. So you don't want to do that. But what you would do potentially is you would wait for a second high in price. So here you had the first swing high, and then notice the price temporarily retraced to the moving average, and then went on to create a second swing high close to 120, about 50 pips higher, right? But here's something interesting. If you scroll down at that point, do you notice how the MACD here, the histogram, it did not actually create a swing high relative to the previous hill? Do you see the first histogram to the very left? Although price created a swing high here, the next time price created a second swing high, the MACD did not. This purple bars, they were not able to match this. And this is a good indicator of a significant sell-off. And you could have made a very substantial gain here. Notice this is almost a 200 pip drop, right? So you could potentially have opened a short order somewhere around here. And for those of you that are using Bollinger Bands in your trading, or if you're using your classic floor trader support and resistance levels, you can always correlate those along with your MACD analysis. For example, if you have a significant resistance here, which you do, 1200 is a very significant psychological resistance point, right, in the market, as is 119, as is 118. Every time you move through these levels with zeros after the decimal points, there's some degree of resistance. And you'll notice that if you correlate that with a divergence, and remember, divergence is simply the fact that the MACD has not been able to post a swing high in its histogram, but the price has posted a swing high, then you have confluence. You have the support and resistance levels telling you something, and you have the MACD also telling you that there is a strong reversal coming, right? And we'll discuss where to set your take profit levels if you're opening a short position, trading this MACD divergence. But what sometimes can happen, and this is of course potentially risky, is that let's say you're not trading on daily charts, right? Let's say you're trading on hourly charts and you get this move down and you miss taking profit here for whatever reason. Maybe you had set your take profit level a bit too low, and actually this divergence is a false divergence known as a MACD fake out, right? Not a breakout, but a fake out. And the price actually goes on to create a third swing high, right? The good news here again is that what you're looking at then is a triple divergence, right? Although the price has created 3 swing highs over a particular period, the actual MACD histogram has failed to create new highs, right? In fact, it's gotten progressively less or tallied at the previous one, and that's a very strong bearish signal, all right? And if you look at the chart to the right, you'll see another form of divergence here, very similar to this one. This one was more straightforward. This one's a bit more tricky. Now, notice here, the price has risen sharply from 103 to 106. Again, this is US dollar, Japanese yen. And it has faced resistance around the 106, 106.50 level, actually closer to the 107 level. And you see a very sharp reversal candle here. For those of you that know candlestick theory, you'll see a sharp shooting star / doji, okay? And you would not actually, if you're going by MACD theory, if you're using your MACD to open short or long positions, you would actually not open a short position here, right? And why you would not do that is because this is the first histogram indication only. Remember, it's like the first hill here. You actually need to wait for the price to create a potential second swing high, and on top of that, for the MACD histogram to not create a second swing high. That's known as divergence, right? So you want this second hill to be at the same level or lower, which was the case in this case, than the first hill. And in this case, mind you, it's topped out at 0.3307. The histogram has failed to rise above 0.3307. And what you're seeing here basically is what is known as a double top in the histogram, right? It's failed to create a new higher high. But price has created a very significant higher high, and that then obviously is a good indication for you to potentially open a short position. And everything I'm saying here also works for long entries, right? So it works for long entries as well. only it's a reverse of the chart. We're just looking at rising markets, but if these markets were falling, everything I'm saying would also work for long positions, right? Now, what else do you see here? Okay, so apart from the basic analysis, which is you're looking for price to create a swing high, a second swing high, not the first one. The first one you do nothing, right? In the second one, notice that, okay, around somewhere around this level here, the histogram, the MACD, right? And remember, the histogram is simply the difference between the actual MACD, the green line, and the very short period moving average, which is the 9 period exponential moving average, the black line. That's all the MACD is. That's all this purple thing is. Mind you, here it has failed to create a new histogram high, right? However, price has created a new high. But what do you also see here? Take a look at the crossover analysis. Do you remember early in this webinar we discussed how if the green line crosses the black line, or in other words, in qualitative terms, if the green line, which is the actual MACD indicator, crosses the fast period moving average from above, right? That itself is a crossover and a potential short signal. Please look here carefully where I'm circling. Let's go back to the previous chart. You remember here we have the same scenario, right? You have the green line crossing the black line, the crossover, and you notice that price comes down with it. So you have here actually two indicators. You have a failure. Notice that the price created a new swing high, but the MACD didn't. And shortly thereafter, you also have an official confirmation with a green line crossing the black one from above that indeed this is probably a larger scale retracement or a drop. And that's exactly what happened. The price fell close to 200 to 300 pips, right? So you can see it can be quite useful. But what I would, of course, advise is that you may get instances where you get these fake outs, where you are getting this divergence, but the price continues to strike higher highs. And at that point, there's absolutely no reason to keep building more short positions. We would never advise that, right? You should let your winners run and cut the losses on your losers. So let's discuss risk while we're on the topic. We would advise you to set your risk levels accordingly before you start to take your actual positions. So if you're scalping, set your risk reward to 2 to 1. Okay, so your total take profit levels should be a multiple of 2 relative to your stop loss levels. If you are scalping, it should be 2 to 1. If you're taking longer term trades, so if you're trading off of 4-hour, 8-hour, or daily charts, we would suggest higher risk reward ratios, maybe of 2.5 all the way up to 4 to 1, right? For the actual setting of your take profit levels and your stop loss levels, you can set your take profit level at the nearest resistance. Let's say if you took a call or a long entry at S1, which is the nearest support level. For those of you that know support and resistance level theory, you can place your take profit level all the way at R1. For those of you that are more conservative in your positioning and you have slightly tighter take profit and stop loss levels, and you can set it simply at the pivot. And the vice versa holds true for short positions. Now, let's discuss dollar cost averaging, because this is quite important for divergence traders. What I've shown you here today is the theory. In practice, you will see that it's similar to this, but it's not always as easy as this. It's always easy to look back at charts and say, look, you could have done this, then, and that. When you're actually trading, there's emotions in the mix, and there's also a little bit of repainting that's happening here. So it actually makes it look easier than it actually is, right? You can actually average into a position as opposed to buying your entire lots, all your lots. Let's say it's 10 lots or 15 lots, or how many ever lots you're buying of a currency, depending on your leverage. You can actually slowly build a position of equal size lots and get a better average price. And we would ask you to do this, right? So for example, let me show you here visually. Let's say you confirm the divergence somewhere around here, right? You notice that the histogram had failed to create a higher high, but the price actually created a relatively higher swing high versus this previous top here. So you would build your first position here, your first short position, but you won't build your entire position here necessarily, knowing that there may be some overshooting. and which tends to happen when there is aggressive moves up in price, right? So you would build your first short position here, set your take profit level somewhere at the moving average, somewhere around here, which I haven't drawn on this chart, but you should be having your Bollingers up. Set your your take profit near moving average, and what you would do then is that for the second indicator here, that the price has actually indeed reached a near-term high, a near-term top, is open a short position somewhere around here. And the reason you would do that is trade the indicator, right? Don't necessarily trade the price. Trade the indicator. And notice the indicator is telling you here that, okay, the MACD is actually crossing the short period moving average, the black line from above. You remember that was the second thing we were looking for. And that generally indicates that at a level of 0.80 on the MACD, that's quite overbought and you could get a retracement. So you would open your second position somewhere here. This position would be the same in size as this one in terms of lot sizes. You're not looking to martingale or double up because that's kind of irresponsible trading. And you'd set your stop loss for the second position at the nearest resistance point. Okay? Whether that's Bollinger based or psychological based. In this case, I see 109.00, which is far enough. But what happens here is that if you are right about your analysis, about your MACD analysis, then the price will retrace sharply and you will probably get a sharp correction, making both your positions go in the money, right? You may have a drawdown on your first position as the price reaches a new swing high, the position that you open here. But if you let it run for some time, you could end up in profit on both. And notice all you did here is that you got a better average in price. As opposed to buying 10 lots here, you bought 5 here and 5 here, and you got a better average in price. And this technique is used quite commonly in investing as well. So that's known as dollar cost averaging. For excess gains, for those of you that are profit hunters and you are confident in the markets and you've kind of done this before, you can use trailing stops. They can be moved up in a long position, especially a position that's in the money but not yet crystallized as a gain, or down in a short position to the next resistance or support level if you want to de-risk your trade. And I believe that the MT4 platform has automatic trailing stop loss management in place. So that's something you can also consider using. Okay. So let's discuss a few dangers in currency trading. So firstly, we would suggest don't trust robots. There are some automated EAs, expert advisors, that are using MACD analysis, that are using solely MACD divergence. They don't really work. It does require a human eye. So be very careful if you are letting these trade for you automatically. We would not suggest that. Also, we would suggest if you're new to the markets, definitely spend some time in learning a strategy. It can be definitely MACD based. It can be based on other indicators. But the most important thing is that you realize only 5 to 10% of traders actually make money in the long run in FX. It's not 30%, it's not 50%, it's just 10%. So if there are 30 people on this webinar, only 3 or 4 are actually going to make money in the long run. 25 of you probably won't, and that's because a lot of you are not going to be spending time in going through learning these strategies and spending time in front of charts. So we would advise, if you want to be in that 10%, definitely do that. Okay, that's it. So I'll take questions now on the MACD, and if I miss anything, you can email us at webinars@hotforex.com. Any questions from anybody? I see a question here from Margaret. Eka, thank you for your explanation, but I just want to make sure that we should wait for a second swing to entry. Correct, Margarita. That's a very good question. So the thing is that you can enter on the first swing, but not alone just based on the MACD. This is the problem. So let me show you what I mean. If you can see my chart now, this is a one-day chart, US dollar, Japanese yen. It's tempting to enter here when the price has peaked you are starting to see some reversal candles, some engulfings partially, and you're seeing that the histogram, the MACD histogram, has peaked as well, supposedly, and it's tempting to open a short position. And it does work sometimes, but longer run, it's difficult to time these. And what you may get is that this is just the first wave in a larger trend up, right? Um, so generally speaking, when the markets rise or when they fall, they move in what is known as impulse waves. Normally they move in waves of 5, and they drop in waves of 3, right? This is out of Elliott wave theory. And you may simply be on the first wave. And if you want to play this micro correction here, going short, that can work. We would advise to actually wait for the second swing. So we would actually advise, the market's not going anywhere, you're not going anywhere. So we would ask you to have some patience and just wait for the second swing, and then confirm below that indeed the MACD histogram has failed to create a second high here. And when that happens, that's a stronger bearish signal. All right. So just to be safe, we would advise that. And yes, correct. The second part of your question with the crossover following the second swing. Exactly. So mind you, here in this chart, what you are seeing is a failed divergence, right? So basically you're seeing that, a successful divergence and basically a failed attempt by the histogram to break the previous histogram's high. This is 0.3634, this black line here. Okay? So here, you're not really seeing so much crossover between the green line and the black line, but you see it more obviously here, right? And notice how that was the largest correction. Great. Any other questions for anyone? Good. Margaret is asking, there must be a minimum of 2 indicators confirm MACD histogram moving average. I would suggest for you to do that. It does not have to be, right? There is no 100% rule that you have to wait for the crossover on the moving average. What we're just saying is that once you get both, look at this chart to the right. Do you see here the chart to the right? Not only do you have divergence, but you also have the crossover happening at 0.7953 on the MACD, right? And that's a pretty strong bearish signal. Now, as a trader, I would look at this and I would run a final analysis. It takes me 2 seconds, is basically to see, is there a major resistance around this point? Mathematically calculated resistance or psychological resistance level. And I would then also just look at the nature of candles, right? This literally takes the mind 10 seconds, 5 seconds. These candles are dojis, shooting stars. These are all reversal patterns, right? Indicating that there is exhaustion occurring in the market and it's possibly time to sell, right? And notice here you also had a very sharp reversal candle, sharp spike, pin bar, classic, shooting star formation to some degree. And again, the price then faced a lot of resistance for the next few days, right? So I would look at the MACD, I would confirm the divergence, I would confirm the crossover, and I would just take a look at the nature of candles. And when I'm seeing those three correlate, for me, it's a very obvious short entry. And if I'm wrong because I'm having pretty tight stops anyway. Any other questions from anybody? Last call for questions. Okay, good. Wish you all good trading, and we will see you next week.